So, the Dow is hovering right around the key 49,386.8 level today.
Yeah, right after a pretty aggressive previous day high sweep.
Exactly. We are looking at a tape that is, actively testing boundaries right now. It's probing for liquidity and basically forcing early hands before the bell even rings.
It's a very tense setup.
Very. So if you stay to the end of this 15-minute briefing, we're going to give you the New York desk's exact invalidation levels and actionable setups. That way you can execute today's session with a definitive structural edge.
But before we begin really dissecting the granular order flow, we need to establish the operational baseline here.
Right, the data.
Yeah, the data we are breaking down right now is strictly preliminary. I mean, the institutional models are still actively digesting the overnight Asian and London handoffs.
So things will shift.
Exactly. The parameters we discuss represent the early structural bias, and they're going to tighten up as we approach the open.
Got it. Well, welcome to the first coffee by AlphaRoute. If you are an intraday trader, a risk manager, or, the decision maker pulling the trigger on an institutional desk, this deep dive is your daily battle plan.
We take the raw, unfiltered structural data from the AlphaRoute algorithms
Right.
and just, translate it into a pure operational edge for the New York session.
No noise, no guesswork, just where the liquidity is heavily concentrated and exactly how the desk plans to exploit it today.
So let's just unpack the preliminary focus summary and the top priorities for the day.
Yeah, looking at the board, the market landscape today is highly bifurcated. I mean, we have some assets trapped in this brutal multi-day compression risk,
Absolutely brutal.
while others are offering incredibly clear, high-confidence Tier 1 structural dislocations. So let's start right at the top of the board with the Dow.
Okay, the Dow. The desk has assigned it a bearish tilt with a confidence score of 78.
But looking at the overnight session, the volume profile heading into that previous day high sweep at 49,386.8 looks incredibly thick. So why is the algorithm so confident this is a reversal and not, the foundation of a multi-day macro breakout?
Well, the algorithm isolates intent over sheer volume. Like when you see a thick volume profile heading into a key level like 49,386.8, the immediate retail assumption is just strength.
Right. The narrative becomes, look at all this buying pressure.
Exactly. But the algorithm strips away the narratives. It looks at the delta, the difference between market buy orders and market sell orders.
Ah, so it's looking under the hood.
Yeah. During that specific sweep, the volume was indeed high, but the aggressive market buying was instantly absorbed by massive passive limit sell orders.
So institutions weren't chasing the price up at all.
No, not at all.
Oh.
They had these walls of supply resting precisely above yesterday's high. They were basically using the momentum of early breakout traders to fill their own short inventory.
Wow. We need to dissect the mechanics of that exchange for a second, because it's essentially the engine of the entire trade idea today. When we talk about a sweep, we are not talking about price casually drifting over a line on a chart.
Right, it's highly engineered.
Yeah, these are engineered liquidity events. Just think about the psychology of the retail trader or, the undercapitalized prop firm trader. They see yesterday's high, and what do?
They place their stop loss orders right there.
Exactly. They put the stops for their short positions right above that line. And conversely, breakout traders place their entry buy stop orders right above that same line, hoping to catch a momentum wave.
And that creates a massive, highly concentrated pool of buy-side liquidity.
Precisely. So the market makers drive the price up into that zone. Suddenly, all those stops trigger simultaneously, and it creates the synthetic spike in buying pressure.
Which is exactly what the institutions need. I mean, if you are holding a massive block of short orders that you need to execute without crashing the price, you need artificial buying to sell into.
Right, otherwise you ruin your own average entry. So you absorb all those triggered buy orders and just exchange your risk with the trapped retail participants.
Which completely explains the 78 confidence score for the bearish reversal today. Once that localized liquidity pool is drained and the institutional short inventory is filled, there is an immediate vacuum underneath the current price.
The upward momentum just wasn't organic.
Exactly. It was a targeted hunt for liquidity. When the objective is met, the path of least resistance is aggressively back down into the established value area.
That is why the New York priority action today is to sell. The desk is looking to capitalize on the exhaustion that immediately follows that engineered grab. We want a return to the mean.
Spot on. Let's move to our second Tier 1 asset, which is gold.
Yeah, gold is super interesting today because we are looking at a mirror image structurally, but operating on the opposite side of the board.
Right. Gold has a bullish kilt And it's also sitting at a very high confidence score of 78.
But instead of the high being taken, the previous day low was swept at 4,554.8. Now, the report explicitly notes that gold is operating in a, quote, normal flow context today. Can you explain what normal flow actually means for execution? Because it obviously dictates how we trade this sweep compared to a high volatility event.
Yeah, normal flow is a critical algorithmic designation.
Yeah.
It basically means the order book is breathing naturally.
Yeah.
We aren't seeing massive latency gaps between the bid and the ask.
Okay, so it's relatively stable.
Right. We aren't dealing with a highly pressurized macroeconomic news environment where liquidity providers get spooked, pull their orders, and thin out the book.
That makes sense.
In a naturally breathing market, the algorithms rely heavily on mean reversion. So sweeps of the previous day's extremes in normal flow are just the absolute bread and butter of institutional intraday setups.
Because without an external macro catalyst to drive a sustained trend, the market inherently wants to return to fair value, right?
Exactly. By sweeping that previous day low at 4,554.8, the tape essentially laid a trap for late momentum sellers.
And it traps them brutally. Just think about the trader who sees gold breaking below yesterday's low. Emotion kicks in, fear of missing out takes over, and they hit the sell button right at the absolute bottom of the structure.
And they are instantly offside. The algorithm detects this structural imbalance. It measures the immediate deceleration in downward price action, which is what we call absorption.
The tape just stalls out.
Yeah, the bid-ask spread tightens. Heavy institutional bids step in to catch the falling knife, and the price aggressively rotates back up. So the algorithm flags the New York priority action as a buy, targeting a return into the range.
It's a classic liquidity trap.
Okay.
But let's look at a glaring divergence on the board today. Our third tier 1 asset is Bitcoin.
Right. Crypto is doing its own thing.
Yeah, the setup is a breakout. We swept the London low at 76,859.9, but every other tier 1 asset we've discussed so far is looking for a reversal back into the range after a sweep.
Yeah, that's true.
Bitcoin is the only one looking for a breakout continuation. Is the underlying bullish structure of crypto just ignoring the broader equity and commodity flow today?
Well, I wouldn't say it's ignoring it, but it's definitely operating on a fundamentally different microstructure right now. Let's look at the internal data. The bias is bullish, the confidence is solid at 76, but the alpha metric is completely neutral at exactly 41%.
We should probably clarify the alpha metric for a second. When AlphaRoute models alpha, we aren't talking about the traditional hedge fund definition of beating a benchmark, right?
Right. In our structural algorithms, alpha is a measure of localized immediate directional probability, independent of the macro trend.
Okay.
So when you have a strong macro bullish bias, but an immediate alpha reading that is totally neutral at 41%, it tells the model that the market is actively coiling, is building kinetic energy.
So the sweep of the London low at 76,859.9 wasn't an exhaustion move like we saw in the Dow.
Exactly. It was a loading phase. They dipped down to grab the necessary liquidity, specifically to fuel a move higher. They needed to flesh out the week-long positions who had their stops just below the London session low before marking the price up.
Because the underlying structure is building momentum rather than seeking fair value.
Right. So the New York priority action is to buy, but specifically as a post-breakout continuation. We aren't fading the extreme here. We're waiting for the structure to prove its upward trajectory above the key levels, and then we ride the wave.
Which highlights the ultimate operational danger of trading blindly. Context dictates execution entirely. A sweep in a mean reverting environment like gold today is a reversal trade. But a sweep in a highly pressurized momentum building environment like Bitcoin today is a bear trap designed to load the spring for a breakout.
You really cannot treat every sweep equally.
Definitely not. Now, moving to our final tier 1 asset, we have the dollar CAD, the loonie pair. This one is deeply complex.
Yeah, it's messy.
The report notes the pair is in a state of compression and consolidation. The overarching structural bias is distinctly bearish, yet the alpha metric is a buy at 66.3%, which gives us a bullish tilt in the localized summary.
Right.
And the previous day high was swept at 1.3690. How do we reconcile a buy alpha inside a structurally bearish tape?
This requires absolute precision and execution. When an asset is in compression, especially a forex pair heavily influenced by cross-market correlations like oil, it is essentially a coiled spring trapped in a box.
The boundaries are just tightening day by day.
Yeah. The sweep of the previous day high at 1.3690 in a structurally bearish environment is a structural aberration. The algorithm is generating that 66.3% buy alpha purely on the immediate micromomentum of the sweep itself. It recognizes the temporary spike.
But we don't buy the spike.
No, we fade the spike. The New York priority action is to sell. The algorithm sees that temporary bullish momentum as an anomaly within the broader bearish context. It's a classic execute on trigger setup.
So you don't just sell because the price hit 1.3690.
Exactly. You sell because it hit the number, triggered the external liquidity pool, exhausted its localized alpha, and is now fundamentally misaligned with the dominant bearish structure. We're using the temporary bullish alpha as our entry liquidity.
Incredible. And before we pivot into the mechanics of risk management and exactly where these structural theses fall apart, I really need to remind the desk one more time. The targets, the alpha readings, and the biases we are outlining right now are strictly preliminary. We are mapping the battlefield using early European flow before the primary New York volume fully materializes. This is a preliminary briefing. For the final validated 9:00 a.m. report, visit alpharoute.versailles.app.
Okay, we are back. So we've established the primary targets. We know exactly where the desk intends to attack the Dow, gold, Bitcoin, and the dollar CAD.
But identifying the target liquidity is only the preliminary step, right?
Exactly. The core of running a profitable institutional desk is risk management. We really need to find the invalidation levels. These levels aren't just suggestions. No, they're the law.
Yeah, they are the structural foundations of the trade. If the foundation cracks, the entire house comes down. Acceptance outside these levels completely breaks the algorithmic thesis. I always say invalidation levels are like your seatbelts. You don't adjust them while the car is crashing. You set them before you put the car in drive.
I like that analogy. The foundation analogy is crucial too because it removes the psychological element of hope. Invalidation is a binary state. Either the structural thesis is intact or it is broken.
Right. There's no in-between.
The desk defines risk not by an arbitrary dollar amount, but by structural failure. Let's thoroughly break down what that means for each of our Tier 1 assets today, starting with the Dow.
Let's do it.
The base case is a reversal back into the range, bounded by 49,076.4 on the bottom and 49,386.8 on the top.
And just to be explicitly clear on terminology here, when we say range, we are referring to the established value area, the high volume node where the bulk of the transactions occurred over the previous sessions.
Right. So the absolute invalidation for the Dow is sustained acceptance above 49,386.8 or below 49,076.4.
We need to spend a significant amount of time defining that word right there, acceptance. What does algorithmic acceptance actually look like on the tape?
Well, acceptance is the dividing line between an institutional operator and a retail gambler.
Huh.
A wick through a key level is not acceptance.
Right.
When we see a sudden low-volume spike driven by algorithmic latency arbitrage, where high-frequency trading firms exploit microsecond delays to flash an order, trigger a stop, and instantly cancel, that is not acceptance. That is just noise.
So mechanically speaking, what validates true acceptance?
Basically three things: time, volume, and closing structure. Acceptance means the market trades through the level, and crucially, new volume begins to transact on the other side.
The TWAP shifts.
Exactly. The time-weighted average price shifts. The 5-minute candles begin to physically close beyond the level. The market is effectively telling us we are no longer probing for liquidity. We have found new fair value outside of your defined range.
Wow. So if the Dow shows sustained acceptance above 49,386.8, the bearish reversal thesis is completely dead.
100% dead, because it means the liquidity grab we anticipated was actually the true genesis of a macro breakout.
And the fatal mistake the report flags for the Dow today is trading without confirmation. I mean, trying to short a genuine breakout without waiting for the tape to confirm the reversal is like trying to stop a controlled demolition with your bare hands.
It's a quick way to blow up an account.
Yeah, the structural algorithms have already detonated the supply zones. There is nothing left to hold the roof up. You must let the tape prove the rejection first. You want to see the market poke its head above the high and then violently fail. You want to see heavy limit sell orders aggressively defending that line.
Right. Now, moving to gold, the risk parameters require the exact same discipline. The base case is returning to the range of 4,554.8 up to 4,701.1.
Okay.
The invalidation is sustained acceptance outside those bounds.
So if gold drops below 4,554.8 and starts building a multi-candle base there, like if the institutional bids we expected completely evaporate and the tape shows heavy, continuous selling pressure hitting the limit orders, the thesis is just fractured.
Fractured beyond repair. And the report explicitly warns that the core mistake to avoid on gold today is fighting the structure bias. The macro bias is deeply bullish.
Right.
The priority action is to buy the reversal.
Right.
If you see it break down below the previous day low and you decide to short it because the immediate price action looks weak, you are fighting the dominant structural flow.
You are stepping right in front of a freight train.
Exactly. You are stepping in front of the institutional algorithms that are preparing to buy at a discount. It is a recipe for severe drawdown.
Let's look at Bitcoin next, which requires a totally different risk framework today. The base case requires post-breakout continuation above 77,452.9.
That's the line in the sand.
The invalidation is sustained acceptance below that exact level, which is honestly an incredibly tight leash for an asset with Bitcoin's historical volatility profile.
It has to be tight, though, because the underlying logic of the trade demands it. This is a momentum continuation play. If we are playing a breakout based on the thesis that the market spent the European session actively loading the spring, we need the market to hold the higher ground once the spring releases.
That makes total sense.
If it breaks out, pushes new highs, and then immediately collapses back below 77,452.9, the breakout was a synthetic bull trap.
The buying pressure was exhausted instantly.
Exactly. Sustained acceptance below that level completely invalidates the bullish continuation thesis. You do not give it room to breathe. You kill the trade immediately because the microstructure has shifted from momentum to distribution.
Cut it and move on. Finally, let's look at the risk matrix on the dollar CAD. We are executing the reversal after the sweep at 1.3690.
Right. The base case is a return to the 1.3612 to 1.3690 value area.
And invalidation is acceptance outside of that range. If it holds above 1.3690, the bearish bias is negated by overwhelming immediate-term buying pressure.
Yep. And just like gold, the primary mistake to avoid here is fighting the structure bias. If the tape proves that the level is lost, you do not average down. You execute the stop and wait for the algorithms to identify the next structural edge. Read the full final report at alpharoute.forsell.app.
All right, we are back. We've heavily detailed the Tier 1 immediate action. We know exactly where the localized fire is hottest right now. But a massive part of running a comprehensive trading operation is knowing what is building up in the background.
You have to watch the horizon.
Exactly. What is quietly brewing beneath the surface. So we are now transitioning into the Tier 2 and Tier 3 assets. These are the directional bias and observational assets. They lack an immediate executable New York edge right this second, but they possess profound structural momentum that requires our active monitoring throughout the session.
Patience is the absolute key here.
Yes, it is. Let's dive into Tier 2, starting with the dollar-yen.
The dollar-yen is flashing a massive bullish bias confidence score of 0.96. To contextualize that for the desk, anything above 0.8 in our models is considered highly significant. And 0.96 means the structural algorithms are virtually screaming that the underlying macroeconomic current is intensely bullish.
Wow.
However, the operational context is deep compression and consolidation.
It is a pressure cooker. The bias is heavily skewed to the upside, likely pricing in interest rate differentials or macro flows, but the actual price action is completely trapped right now. The previous day high was swept at 159.78, but there is no clear New York edge right now. The algorithmic action plan here is weight rotation. We need to observe how price behaves within the established tightening range of 158.95 to 159.78.
And honestly, this is where retail traders destroy their accounts. They see a 0.96 bullish bias, and they blindly buy the top of the compression zone at 159.7.
Just buying the top.
Yeah, they buy right into institutional resistance. You must wait for the market to rotate down toward the lower boundary of 158.95. You wait for the market to offer you a discount, and then, and only then, do you look for execution triggers confirming the bullish bounce. Executing in the middle of a compression zone is mathematically equivalent to flipping a coin.
Exactly. Moving to the heavy indices, both the NASDAQ and the S&P 500 are sitting in Tier 2 today. Both have a bullish bias, the NASDAQ at 0.66 and the S&P at 0.56, but neither is presenting a clear New York edge yet. The S&P specifically swept the London high at 7,157.6. But what really fascinates me is the diagnosis on the NASDAQ. The report explicitly states, bias bootstrap in progress, awaiting confirmation. What does a bias bootstrap actually mean mechanically for the order flow?
So a bias bootstrap occurs when the recent trailing variance in the market suddenly exceeds the standard deviation parameters of our underlying structural model.
Okay.
Essentially, the market has introduced a new variable, perhaps an unexpected earnings print from a mega-cap tech stock or a sudden shift in bond yields. That makes the historical data scale. The algorithm recognizes that the old fair value is no longer valid.
So it just throws it out.
Basically, yes. It
Okay.
effectively throws out the stale parameters and runs a real-time Monte Carlo simulation to find a new equilibrium. It is bootstrapping a new bias from scratch based purely on current localized order flow.
So the initial data suggests an underlying bullishness, but the model refuses to issue a high-confidence operational edge because it is still actively recalibrating?
Exactly. The confirmation isn't there yet. That forces both of these massive indices strictly into weight and rotation modes. We're looking for intra-range rotation on the S&P between 7,015.1 and 7,092.1.
So until the tape accepts a clear direction outside of that rotational noise, we keep our powder completely dry.
You have to. We see a virtually identical holding pattern in the commodities and forex crosses within Tier 2 as well. Silver has a bearish bias with a confidence of 0.62, but it is waiting for intra-range rotation between 72 even and 76.12.
And cable.
Cable, the pound-dollar pair, has a bullish bias at 0.73. It's repped the London high at 1.3514, and the base case is intra-range rotation between 1.3462 and 1.3540.
The overarching psychological mistake to avoid across all these Tier 2 assets is trading without edge. The market will tempt you. It will flash rapid, aggressive movements inside these ranges, creating the illusion of momentum. But it is all structural noise until the outer parameters are definitively breached and confirmed by volume.
Exactly. Now let's step into Tier 3, the observation assets.
Yeah, the report lists Ethereum, Eurodollar, the Kiwi, and the dollar Swiss as strictly observational today. They are waiting for rotation or breakout, but the signals are far too muddy to commit institutional capital. However, digging into the raw data, the Aussie stands out aggressively.
It really does.
The Aussie dollar is flashing a structural anomaly that demands our immediate attention.
The data on the Aussie is exceptional today.
The report explicitly notes a strong selling directional pressure of negative 0.388. Before we look at the price action, explain the mechanism behind that specific metric. What does negative 0.388 actually measure in the order book?
Directional pressure is an algorithmic measurement of aggressive versus passive order flow. It tracks market orders hitting the bid versus limit orders absorbing them.
Okay.
A score of negative 0.388 means that for every block of volume transacted, almost 40% more of it was driven by aggressive market sell orders tearing through the bid, rather than passive absorption. It is a highly aggressive footprint.
And the crucial detail in the report is that institutions distributed this inventory before the sweep at 0.714980. This implies heavy, premeditated institutional unloading. They didn't even wait for the sweep.
That is the exact structural paradox we need to monitor. Normally, institutions use the sweep itself to distribute their massive positions. They wait for the price to spike above a high or drop below a low, triggering the retail stops, and they use that sudden flush of artificial liquidity to quietly exit their trades without moving the market against themselves.
Right, that's the standard playbook.
But the data clearly shows they distributed heavily before the previous day low was even breached.
They were front-running their own liquidity bill. They were hitting the bids on the way down, actively driving the price lower, and absorbing all the limit buy orders before 0.714980 was even touched. A directional pressure of negative 0.388 in a supposedly bullish biased macro environment is a massive, glaring divergence.
It really is. It usually indicates that institutional operators possess macroeconomic data or deep order flow insights that override the immediate technical structure. They don't care about the bullish bias. They want out of their inventory immediately.
Wow.
The operational conclusion on the desk is to wait for intra-range rotation between 0.714980 and 0.719360. But with that kind of aggressive distributional footprint, you have to monitor the tape relentlessly.
It's a giant warning sign painted right on the chart. If you are blindly buying the Aussie today, just because the broader bias summary says bullish, you are stepping right into the teeth of institutional sell algorithms that are actively offloading risk.
Exactly. And I must remind the desk, as we analyze these deep institutional flows, this data is absolutely preliminary. It is the raw, early morning read. The market is a highly dynamic entity, and these parameters will tighten, shift, and validate as we approach the bell.
Which brings us to the final New York Open game plan. We've synthesized a massive amount of structural data, but it all distills down to a few critical, actionable notes. The overarching theme for today's session is extreme selectivity. The Dow and gold reversals are your prime Tier 1 targets. The parameters are mathematically set, the sweeps have occurred, and the structural edge is highly defined.
But execution strictly requires confirmation. We cannot stress this operational rule enough. The day's biggest pitfall, flagged across almost every single asset on the board today, is trading without edge and trading without structural confirmation.
Totally agree.
Whether you are stalking the bearish reversal on the Dow, the bullish reversal on gold, the momentum continuation on Bitcoin, or the highly technical compression play on the dollar CAD, you must let the tape prove the thesis. Watch the 5-minute candle closes. Monitor the volume deltas at the invalidation levels. Do not anticipate the market. React purely to the structure.
And as we move into the open, remember that the landscape will shift. The preliminary parameters give us the baseline map, but the final validated order flow is what actually moves the needle.
Yeah, and the final validated report is published daily at exactly 9:00 a.m.
That is where the preliminary European noise is stripped away, and the definitive New York institutional levels are locked in. Make sure you have that validated data in front of you before you put capital at risk today. If this briefing helps you, subscribe on YouTube and follow us on Spotify and share this episode to support the channel. It allows us to keep bringing you this level of uncompromising institutional-grade analysis every single morning.
Finally, an important operational reminder regarding everything we discuss on the desk. This briefing is strictly for informational and educational purposes only. It does not constitute financial advice, and it contains no financial promises or guarantees of profit. Intraday trading involves substantial risk, and listeners must evaluate their own risk tolerance and consult with their own financial professionals before executing any trades in the live market.
We are walking into a session with massive executable potential, but also severe hidden traps. I'll leave you with this final thought to chew on before the bell rings. If institutions were already actively distributing the Aussie before today's sweep even triggered, what does that tell us about their broader timeline and macroeconomic outlook heading into the rest of the week? Watch the tape closely. Have a great session.